And there's only two assets that have actually outperformed, which were crypto and technology. Okay, which is why we all feel like even though stocks are going up and our 401k is going up, nobody's getting any richer. Okay, we all know this intuitively, that we're not actually getting richer because the stocks I sell doesn't buy me more of a house. So what was the point of buying the stocks if I?
Hey guys, welcome back to Everyday Finance. In this video, Raoul Pal discusses Bitcoin and crypto. Globalization is often cited as a significant contributor to the widening wealth gap. Companies utilized labor arbitrage to outsource manufacturing jobs to countries with lower labor costs, resulting in reduced production expenses and increased profits for asset owners. However, while these owners or shareholders prospered, the middle class, who were previously employed in those factories, faced job losses or stagnant wages. This issue highlights the disparities caused by such practices. In an interview with Tom Bellew, Raoul Pal delves into the cyclical nature of debt and the resulting financial instability, specifically focusing on the consequences of the 2008 financial crisis. The crisis exposed the vulnerability of the global financial system as individuals and governments increasingly turned to debt to make up for stagnant real wages. This shift has played a significant role in the increase of social issues such as the opioid epidemic, as individuals experiencing economic difficulties and despair have resorted to drug use. Raoul highlights the importance of addressing this economic disparity and the resulting social issues as a necessary step towards tackling broader systemic reforms. And lots of things Raoul Pal discusses, so please watch the video to end and share this video and subscribe our channel, Everyday Finance. Thanks.
You can either raise taxes, which they're trying to do too, but they're also printing currency via the mechanism called quantitative easing, which is actually debasing the currency, which means that every time they do it, asset prices optically rise. They don't actually rise. Because if you look at the central bank balance sheet and divide all assets by it, so you're changing the denominator, it's normally US dollars, but when you use the balance sheet, you say, okay, this is the purchasing power of dollars. Now, how many dollars are in the economy or excess printed? And what you find is something like the S&P 500 has gone nowhere. Real estate, gold, gone nowhere. And there's only two assets that have actually outperformed, which were crypto and technology. Okay, which is why we all feel like even though stocks are going up and our 401k is going up, nobody's getting any richer. Okay, we all know this intuitively, that we're not actually getting richer because the stocks I sell doesn't buy me more of a house. So what was the point of buying the stocks if the value of my assets aren't going up? But that is a mutualization, which is bad because it mutualizes it amongst people who don't have assets. So you'll never be able to buy an asset, which is why when you speak to a millennial now, they're like, we can't afford a house. Why? Because they came in to the labor force after the Fed started monetizing or lowering the value of the denominator. So property's got more and more expensive for them. It's impossible for them to buy property, really, unless they're really lucky in the workforce or in entrepreneurship or whatever it is. But generally speaking, it's become impossible. And everything has got more and more expensive, assets have, because of this optical illusion. But wages haven't gone up, remember, right? That's the key thing. Assets are going like this. We were doing this before because of demographics, and it was making people pissed. And now we're doing it from debasement, and there's no way around it. So what debasement does, on the other hand, remember, it makes the price of assets look like it's going up. This is why you can't have a banking crisis of the order of magnitude that existed before 2008. The reason being is you just print money the moment you see it, and voila, everything goes up. So the value of your collateral, so if you think about a debt, it's collateral plus the debt, and the collateral is what guarantees the debt. If you've got a banking crisis, your collateral is often falling so fast that, like commercial real estate, right? We're going to have a problem with that. So there's a bunch of debt, and the the banks have got this commercial real estate as collateral, and it's all bloody empty, and everybody's going to try and get out of it. So the answer to that is print money and essentially magic that collateral higher, or put it on the central bank balance sheet. Europe has already done this. So I don't think you can have a systemic collapse because the value of the assets can never go down enough. This is what most people can't get their heads around.
Well, so I'm gonna.
But we will get slightly. But we'll play out the future a bit, because there are ways where it could go even more wrong than this ongoing mutualization amongst the people of the costs.
It can go even more wrong.
Well, this is wrong because it's insidious. You don't see it, you don't notice it, you just sense it, right? That's what's going on. But it could lead to another outcome, and the other outcome could be a total loss of control of the financial system. I don't think that is going to be the case.
Despite historical trends suggesting a potential September downturn for Bitcoin, some traders are unfazed by these concerns. The current macro environment, including a potential rate cut by the US Federal Reserve and a strong US economy, could challenge the prevailing narrative. In fact, we believe there is a higher likelihood of Bitcoin settling above $60,000 than below it. As of the time of publication, Bitcoin is currently trading at $6,633, which has stayed below $60,000 since August 30th. However, future traders do not expect a significant increase back up to $60,000 in the near future. If Bitcoin reaches $60,000 again, it is estimated that short positions will lose more than $584 million, as per CoinGlass data. Meanwhile, according to crypt trader Don Crypt, the average return in September is around 4%. Despite Bitcoin's volatility, this return is not as negative as some may think. According to recent data, September has consistently proven to be a challenging month for Bitcoin. Over the past 11 years, the cryptocurrency has experienced an average monthly loss of 4.49% during this particular month. Dan Crypt Trades mentioned his focus on Bitcoin's longer-term price chart, looking for signs of a bullish market where buyers dominate over sellers. He emphasized the importance of BTC trading above $65,000 to demonstrate strength. This aligns with crypto analyst Matthew Hyland's view, who also stressed the need for a higher high after Bitcoin's recent drop below $58,000 on August 30th. It is crucial for the market to bounce back and confirm the ongoing uptrend since August. Let's back to the Raoul Pal interview.
It's your future consumption has gone up so much that nobody can afford them. So you've kept them happy with dopamine and sugar hits of crap.
You've kept them numb. I won't say you've kept them happy. You've kept them numb.
Okay, yeah, happy is the wrong word, but you're right. But look, I went down this journey that you're going down now in 2012. And that journey led me to crypto. I saw it and I knew that this was the answer. And that's why I first bought Bitcoin in 2013, was exactly this, is once you see what has happened, we know the system now, regardless of how it ends, whether it ends in slow, ongoing death of economic vibrancy or a spectacular blow up, the answer is you need to transition to what I call the Bitcoin life raft or the parallel financial system. It's there, and you can participate with $1 or $1 billion. It's an
okay. We're gonna get to crypto.
System. This is the bit we talked about, right? So the economy grows at 2%. The government needs that to pay its interest because it's 2%.
How does it use that to pay its interest?
Well, basically, it comes
because they're just taking more in taxes.
Exactly right. There's a level of economic growth that needs to service the interest payments. But if everybody's interest payments are too high, the answer is firstly to have the interest rate as low as possible, which is why the Japanese have a much lower natural rate of interest than everybody else, because they're 260% of GDP in debt, but their companies are less in debt.
So they've trapped themselves. They have so much debt they can't let the interest rate rise.
Nobody can. This is why we're going to have a recession and we're going to cut rates back down to zero. It's impossible to work. So this is the thing is once all of these governments hit 100%, then you either blow up the private sector, the banking sector, corporates, or the government
Why?
sector. You choose. Because
I
there's
don't
not
understand.
enough income to service that level of debt because GDP growth keeps declining.
Okay, so let me see if I understand this. So when you say private sector, you mean private banking?
No, I
Not
mean all private sector, households. So how does the average person service the interest? It's again from economic activity, the activity that they have. So the same with corporations, and the banking system is involved intricately within that whole system. So economic activity is what pays the interest. If you don't have a job, you can't service your mortgage or your credit card, right? Fact. And if your debt growth keeps going up, you need to keep your wages going up to pay your debts. That's the GDP side of the equation. But what we're finding is that all debt that is in excess of GDP at government level is ending up on the balance sheet 3.5 years later.
okay. How?
Quantitative easing. And I did the maths on this, and I think I was the first person to really figure. I don't think anybody's really figured this out yet. I went and looked at this, and I realized that what they were monetizing was the interest payments on the debt 3.5 years later. Okay, why 3.5 years? In 2008, all interest rates went to zero. Every government refinanced itself at zero. And most of the debt for all governments is in the 3 to 5 year sector. So somewhere between 3 to 5 years, 3.5, 4 years. And what happens is every time you service the debt, you need to get the interest rates back down again. You end up having a recession. You get this very cyclical phenomena.
Because are they deferring the need to pay for 3 to 5 years?
Nobody pays back debt. Nobody. Nobody is paying back any debt anywhere. So what they're doing is every time it comes to pay to service the next amount of debt, it ends up on the Fed balance sheet. Now, it actually happens because there's an economic slowdown driven by the debt, but that's what happens. And there is a marginal difference in the size. This is true of the US, the UK, the EU, Japan. They're all the same. And the difference of the balance sheets is slightly bigger. And the difference is every time there's a direct financial crisis, they have to put direct money in. So we've already just seen a little bit of that in the US.
Cryptocurrency. The market sentiment has taken a turn towards extreme fear as Bitcoin experienced a brief drop below $56,000. Arthur Hayes, the co-founder of BitMX, has predicted a potential further decline of 12%, which could push the price below $50,000 during the upcoming weekend. The Crypto Fear and Greed Index, which assesses market sentiment and trends, recorded a score of 22 on September 6th. This indicates extreme fear, marking a 7-point decrease from the previous day's score of fear. It is the lowest score since the index reached 20 on August 8th, and the first time it has re-entered the extreme fear zone since August 12th, when the index hit 25. Bitcoin has experienced a decline of 2.7% in the last 24 hours, reaching a low of $55,000. This drop from above $58,000 has resulted in a loss of $29.7 billion from its market capitalization. However, there has been a slight recovery from its low, and it is currently trading at 56.58 BTC. The market for Bitcoin is currently showing significant activity. In a September 6x post, Hayes, the former boss of a crypto exchange, expressed his prediction of the price dropping below $50,000 this weekend. While Bitcoin has been facing challenges in gaining momentum, concerns about a sluggish United States economy have been raised due to the release of disappointing U.S. jobs data on September 5th. This has further heightened worries about the anticipated Federal Reserve interest rate cut. If you learned something from this video, then please like this video and subscribe our channel Everyday Finance, and we will meet in next video. Thanks.